We'll speak to Howard Lutnick of Cantor Fitzgerald on Trump 2.0 economic policies and Krishna Mamani of Lafayette College on the Fed's data predicament. We begin this hour with stocks looking to recover following a shakeout in the tech sector as much weaker than expected earnings from Europe's ASML weighs on investor sentiment and triggers a sell-off in chip makers around the world. Joining us now to discuss, Sam Stovall of CFRA. Sam, can you give us your thoughts on ASML? Is that an ASML problem or a broader tech problem?
Good morning, Jonathan. I think right now the expectation is it's more of an ASML problem, but certainly when the expectations have been as robust regarding the semiconductor chip area as well as the equipment area, and with the bar being set fairly high for these groups, I think that there is the likelihood that there could be some disappointments along the way, yet we still believe that 12 months down the road, technology in general, semiconductors in particular, are likely to be market outperformers.
Well, Sam, I can think of one very specific example, NVIDIA. It doesn't take a lot to spook NVIDIA given the rally that we've seen so far year to date. Yesterday was no different. The stock was down by almost 5%. That's a $160 billion move. That ain't nothing if you're looking at the situation with NVIDIA. Sam, when you look at that name, close to an all-time high still, we had an analyst on the program who said yesterday, yes, the stock's at a record high, but valuations aren't. You can stick with this, you can buy it. Do you want to stay with the winners?
Yes, I want to stay with the winners. I want to stay with NVIDIA. We have a buy recommendation there. We have a strong buy recommendation on Marvell. So our belief is that we're going to be seeing some pretty good growth. 38% is what's expected to be shown in this third quarter for the semiconductor group within the S&P 500. This year, 52% growth. Next year, 42% growth. So a lot of the analysts are looking to 2025 and 2026 earnings, which is going to be an additional 20% growth in this area. Certainly, the rate of change is slowing, as I just indicated, but our belief is that we are still very early in the innings of this sector.
Based on that, Sam, can we use these terrible words that people tend to try to avoid, this time is different, given the fact that you pointed out that typically when you have a two-year bull market, and you do wish the two-year bull market a happy birthday, the three following years really come with some pretty tepid upside gains. Do you think this time is different because of the leadership from some of these tech behemoths?
Possibly, Lisa. Well, just to summarize what you were introducing, we've had 11 bull markets since World War II that celebrated their second birthday. On average, the third year, the market has been up an anemic 2%, with 3 of these 11 falling into new bear markets, 2 of those 11 posting declines, but not enough to be called bear markets, and 3 more showing gains that are 6.6% or less, so pretty weak returns. Only 3 times did we have something worth writing home about, and what is consistent this time with those 3 that did well is earnings growth expectations. 13% plus is the expectation for the coming 4 quarters, so meaning through September of 2025. We're looking at double-digit growth in earnings, whereas we were seeing more of earnings growth, about half of that in the average third year since World War II.
And I'm struck by not only just the tech earnings and what people are expecting going forward, but also the bank earnings we just got. And not just because they were beats across the board for the banks, but the fact that they seem to open to the idea of potentially expanding some of their lending books, potentially expanding risk as they try to capture on the upside of some of these rates. What does that do to your impression of smaller businesses, of the rest of the 493 names, and the potential there?
Well, if they're willing to capture more risk, then what it means is that they are sort of opening up the floodgates a little bit more for the mid and the small cap stocks so that they can borrow and expand their operations. Because right now, mid caps are trading at a 28% relative PE discount over their long-term average. Small caps trading at a 32% relative PE discount. So certainly with us now likely to be avoiding a hard landing, maybe even avoiding a soft landing to no landing, that would be beneficial to the mid and small cap stocks, especially if their lenders are more willing to do so.
You've been consistent, but this narrative seems to change every other week. Sam, appreciate the update, sir. Sam Stovall of CFRA. Some outperformance on the small caps this morning. For the mega caps, the large caps on the S&P 500, just about firmer by almost 0.1%. With an update on stories elsewhere this morning, with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Morgan Stanley shares up 3 1/3% in the pre-market. The bank posted a beat across the board for its third quarter earnings. Revenue for the bank's trading, wealth management, and investment bank divisions all topping expectations. Net interest income coming in at $2.2 billion, well above estimates. Morgan Stanley also reported that its total client assets have now surpassed $7.5 trillion. Vice President Kamala Harris and former President Donald Trump remain neck and neck in the latest presidential poll. In a nationwide survey conducted by Marquette Law School, Harris leads Trump 48 to 47% among likely voters. The poll has a 4.7% margin of error. Election day is 19 days away. And stargazers are in for a treat this week and this holiday season, Halloween season rather. This month's supermoon will be one of the closest ones of this year. The supermoon will be 222,055 miles away tonight and reach its full lunar phase tomorrow. In addition to it looking bigger and brighter than previous ones, this supermoon will be accompanied by a comet, causing a rare stargazing activity and opportunity for spectators. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, the Morning Calls Plus. Howard Lutnick of Cantor Fitzgerald on Trump 2.0 economic policy. Must watch. Up next on the program, live from New York. This is Bloomberg.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power. This is Bloomberg.
Equities on the S&P 500 just a little bit firmer, up by close to 0.1%. In the bond market, that rally continues. Had 4 weeks of yields climbing on a 10-year. This week, they're pulling back. We're down about 3 basis points on a 10-year, just about holding on to a 4 handle on a 10-year yield. Let's get you some morning calls. First up, Citi removing ASML from its European focus list, saying its 2025 sales outlook now looks too high. Next up, Telsey Advisory cutting its price target on LVMH, citing its disappointing organic sales decline. That stock is down by close to 5%. And finally,
Talk to him. I don't say make the decision at all.
Trump sidestepping whether he would replace Fed Chair Jay Powell before his term expires in 2026. We get lucky this morning. Joining us now is the Cantor Fitzgerald CEO, Howard Lutnick, also serving as co-chair of Trump's transition team. Howard, it's good to see you, sir. Welcome.
Good to see you.
This is a big job, and I don't think people outside the United States realize how big this job actually is. So let's start there. Walk us through how big this position is for you and how busy you might be in the next few months.
All right, so the President of the United States gets to put 4,950 political appointees into the government. So 3,700 can take the field on January 20th, and 1,200 go through the Senate confirmation process, which takes a long time.
So you've got to start thinking about people like yesterday. So let's talk about that. The last time the president was in the White House, he attracted a lot of talent. And we can think of several names. Ambassador Lighthizer came up in a conversation with Bloomberg yesterday. That's one. Gary Cohn's another. Some of the nominations to the Federal Reserve too, including Governor Waller to go to the board. It came with a lot of churn, though, at the time in the first term. How do we get one, attract the talent, but avoid all the churn at the same time? How's the approach going to differ this time around?
Well, remember, last time he was a freshman. You know, he comes in the first time. He's not really sure exactly how it goes. And so he acts a certain way. Now, complete experience, complete knowledge, knows for it, and it goes down like that. And so we have 5,000 people already that we know who have been vouched for by the greatest people. You got Ross Perot in energy and Chuck Schwab doing finance, and everybody